Welcome back to part 4 of our 4-part series on understanding endowments unfiltered. We have done from part 1 to part 3 where we went down and dirty, going to explain how endowment policies work, how exactly they're structured. Could they be for you? Could they not be for you? In part 2, we even spoke about, okay, now you have an endowment policy and you feel stuck. What next? What can you do to get yourself out of that situation? Part 3, we went deeper into if you wanted an alternative plan. Yeah, instead of now having endowment policy, which is a hybrid product of a life cover and a saving, what if you wanted to separate the two? And also, what are the pros and the cons? We went and were extremely diplomatic, by the way. Yeah, I was very objective. I did pros and cons of both plans, of both endowment policies, and also, separating the life cover and the investment plan. And this part 4, it's all about the numbers, because again, we've been saying, oh, this one is expensive, oh, it's cheaper to take a pure life cover, but how do the numbers really look like? In this video, we're going to explore numbers, ching, the money, right? So that whatever it is that I've been saying is not going to be seen as guesswork. What we're going to do, we're going to pick a specific provider and we're going to compare their endowment plan versus if we were to do a separate pure life and an investment plan or a savings plan, so that at the end of the day, you can decide what is best for you. You'll be able to see the opportunity cost. You'll be able to see how this one grows versus this other one, so that even as you're making a decision, you know what is best for you. Because again, just as I've said in all the other videos, the most important thing is to understand who you are and to understand where you are and where you're going. And then with that, you'll be able to make the best decision for yourself. So we're going to do a very thorough breakdown. So you can see, okay, when it comes to endowment policy, I'm paying this amount. This is the level of protection I'm getting. This is the level of return I'm getting. And also same thing when it comes to separating the life cover and the investment plan. This is what it is that I'm putting in, and this is what it is that I'm getting out. And then at the end of the day, we are also happy to answer any of your questions and also guide you if you want to go down this direction of separating the pure life and investment cover. But yes, please come here willing to learn. As I said from the first video, forget everything you think you know about insurance, about endowment policies. Open up your mind, open up your heart, and see what works best for you. Let us look at a case study. So how do endowment policies work? Let's just reiterate. We've spoken about this in the first episode of this series. So these policies split your premium payments into 2 parts. There's the first portion which goes towards a life cover, providing a death benefit, critical illness benefit, and disability benefit. And there's the second portion which is invested in conservative low-yield savings mechanism within the insurance company. Look at this pie chart so you can understand how exactly your premium is split when you put money towards an endowment policy. This is now in the back end. This part that goes towards the life cover, part that goes towards the savings or investment, and part of it that definitely goes towards the management fee. And this is a way that a lot of you have been going about it, but we've had to go through this so you can see what are the alternative ways of planning around it. Say, for example, instead of you putting the whole amount of money towards an endowment policy, what if you are able to put money aside towards your own life cover, put money aside towards your own investment plan, so that we can minimize the cost and maximize on the benefit. Let's look at an example of an endowment policy, and we decided to compare apples to apples. So this is an endowment policy with a specific insurance company, let's say insurance company X, and the person was putting this money aside for the next 20 years, and they were looking into saving for their children's education, right? So with this endowment policy, how it has been structured, it means that in the case Anne, who is 30, by the way, was to pass away,
the sum assured will be paid to her family immediately is the 4.16 million, right? And the benefit that she would get, again, if it was upon maturity, is the 10 million. And in case of now bonuses which have been added to the overall benefit, is the 2.6 million. This is all calculated by the insurer. So upon maturity, she will get 12.6 million to spend towards her child's education, right? And what would have happened if she was to die, right? So if she was to pass away, the amount of money that would be paid out is the sum assured, which in this case you can see is the 4.166 million, right? And because it's an endowment policy, and remember they're all structured differently, so it's important to know how yours is structured. Not all of them work like this. For this specific one, there's an amount of money that's paid immediately, and then upon maturity, which means after the 20 years, the family or the children will receive 10 million to take them to school. So the total payout upon death will be the 14.16 million. So the 4 million for in the case of the death, and the 10 million later on at maturity. And then, what about if she was to get a critical illness? Because her sum assured is 4.16 million. Usually, the critical illness benefit is half of that. That means she'll be paid immediately 2.08 million shillings. And then the amount of money that will be paid at maturity is 10 million. So the total amount that will be paid at this given time is 12.08 million. And then also in the case it was an accidental death, usually accidental death, they pay out, again, as I said, depending on the insurer, but a lot of insurers pay double the sum assured. So in this case, double of 4.166 is going to be 8.33. If she was to die prematurely because of an accident, the family will receive 8.33 immediately and 10 million upon maturity. And remember, this is dependent on you paying the premiums consistently, right? Because with this one, you cannot just stop. And the amount of premium that she has to pay per month to be able to get this benefit is 29,666. So that is how this education or endowment policy looks like. So now we're going to go next to, we're still going to use the same insurance company, just that it's going to be different products, because this one, remember, was an endowment or education policy. But what if Anne wanted a bit more flexibility? She wanted a bit more control in putting money aside towards her own insurance and putting money aside towards her own investment. So how does transitioning to separate life insurance and investment approach look like? Because we have established insurance is important, right? Because you can be putting money aside. You don't know if you're going to die in year 5, in year 10. We need to make sure no matter what happens, there's still going to be some level of payout. That's why protection is important. And also, additionally, we need to make sure that the money is growing, right? Because after those 20 years, we need to make sure that there's an amount of money that will be paid out. Let's look at this case. This is a pure whole life cover. That means it has no investment component. It has no savings component. It's just a pure risk product. And the reason why Anne chose this is because she did want protection during the period of time that she's, putting her investments in order. But at the same time, she just wanted a cover that is going to be there for the rest of her life. Because remember, with the first case, with the endowment policy, if 20 years are over, it means after the 20 years, she has no access to critical illness cover. And after the age of 50, she could even get a cancer, but because she has no access to that, it means it will not pay out to her. And she wants permanent protection. So she chose a pure whole life cover. And here we're looking at the benefit of 10 million shillings, right? That is the sum assured in case she was to pass away. That's the amount of money the family receives. And then usually to cater for inflation, this specific insurer puts aside additionally 2% of the sum assured every year towards your life policy to cater for inflation. That means every year there's going to be an extra 200,000, which is 2% of 10 million that is going to be added for the if she was to pass away after year 20, so 200,000 times 20, it goes to 4 million. The amount of money the family will eventually receive is 14 million. If she was to die in year 1, just the 10 million will be paid out. If she was to, God forbid, pass away in year 5, it will be the 10 million plus 200,000 times 5 years, which is 11 million, right? So these are the benefits in the case of death. that is what is going to be paid. And this has a waiver of premium. That means in the case that she was to pass out, in the case now she was to get a critical illness, she no longer has to pay the premiums moving forward. And then what in the case if she's to get a severe illness? So the severe illnesses here are like cancer, heart attack, stroke, paraplegia, coma, aortic surgery, major organ transplant, because you never know. Yeah, life is a long journey. Someone might not die, but Anne could get an incapacitation. She could get really sick. So in the case she was to get a critical illness, the payout will be 5 million shillings. So at least the 5 million shilling will be paid out, and you can see it's even so much more than what is being paid in the endowment policy. And the amount of money, can be used towards her care, or even put some of it towards the pot of investment that she had at later. In the case of an accidental death, it means another extra 10 million is going to be paid. So in case of an accident, that means the 10 million from the sum assured will be paid out, plus another 10 million in the case now of the accidental death, making it 20 million. So the benefit of this policy, the amount of premium she has to put aside is only 8,000. That means all she needs to worry about is 8,000. She needs to make sure that 8,000 is what she needs to make sure that has been put aside in the case of the unforeseen. Because remember, with life covers, you cannot just pull out whenever. Just the same with like an endowment policy. So instead of her thinking about 30,000 per month, all she needs to think about is the 8,000, right? So let's look at if she was to combine now the pure life cover plus an investment. So remember, with the endowment policy, she's contributing 29,666 per month. And the insurance premium from the whole life cover pure risk product is coming to 8,181 with a sum assured of 10 million. So if she was to put aside 20 of money, which is the 21,485 towards the investment, that means let's look at now this education fund. Contribution per year will be coming to 257,000 at an interest rate of 12%, which is compounded. So for the 20 years, the contribution should have made is 5.156 million, but the total interest gained over that period of time is 21 million. So you can see the fund has ended up growing so much more because of obviously consistency and the access to a proper cover. A proper investment plan, which is a bit more giving a better return on investment. And this is just a normal money market fund. And I know, yes, this is now putting into consideration or an assumption of the 12%, but it could be bouncing anywhere between 8 to 12%. But you can see, even if it was to go a bit lower, the amount of money will still be quite on the higher side. And for the people who want to plan for their kids' education, they could use a trust fund. We're going to give you more information on the description box below, because we have more information and a video specifically on trust funds. And you will see now the importance of setting up a trust fund for education planning, because there's proper structure around it. And yes, that's it. You can see there's the endowment plan and there is the investment plan. So it is up to you to see what works best for you. My final thoughts is, by transitioning to a strategy of pure life insurance for protection and separate investment for savings, you gain more control over both your insurance and financial growth. And this setup not only enhances flexibility, but it also empowers you to make choices that align with your unique goals, offering a path towards real financial freedom and empowerment. And at the end of the day, the ball is in your court. It's up to you to see, is my level of discipline high? If it's not, do I need now to go towards right? Or if I feel like I am more conversed with how insurance work, how investment work, can I actually split and make sure that I'm disciplined throughout the process? So this is up to you, your overall goals, and to see what works best for you.